Welcome to this week's 5 in 20, where we cover 5 topics in 20 minutes. I'm here this time with Matthews. Hey, Matthews.
How's it going?
It's going good. Let's hop right into it. So, I remember when Bernie Madoff was caught, and remember being just so sad for our industry and those families. And it seems that saga has officially come to its final end with him passing away, I believe, last week in the news. But that gives us some pause. We have a local person here in Atlanta that's still on the run from doing such things. But there's ways that we can avoid this, right?
Yeah, I mean, this was kind of one of the biggest ones of all time. He was serving a 150-year sentence because he defrauded over 37,000 people in over 130 countries. The amount of money is outrageous. It was over $60 billion that he had defrauded people. He had set it up as, his kids were working and a lot of other close family and relatives were working for his legitimate business, which was the trading side of things. And then he had the other side where he was actually just everything that the checks were written for were going to his Chase bank account, and he was spending on his lavish lifestyle. So you mentioned things that we can do separately is kind of separating those powers and, being, the fee-only side of things that we operate as custodians at TD Ameritrade, but we're not actually physically accepting the checks. It's being custodianed at TD Ameritrade.
Yeah, the money can't be the same place to the advisor as. You never write a check to the name of the financial company. You write a check or to the name of the person giving you advice. You write a check to, in our case, we use TD Ameritrade or we have a Betterment platform as well. Checks and deposits are going there, and then we get assigned as managers on the account. What that does is create that separation that you're just talking about between the asset and the advisor. So many people, I guess, even then, though, Bernie Madoff also had that separation. But the problem is he was the owner of both companies. So if you want to be sure, always make sure that the custodian is somebody reputable. You've got a TD Ameritrade, you've got a Schwab or a Fidelity that's the custodian. Most independent firms, if they're reputable at all, will be on one of those 3 platforms. Outside of that, I would ask a lot of questions. So
yeah, the thing that was scary about him is, he was a big name on Wall Street, and then in the 90s, he was actually one of the chairmen on the NASDAQ. So very prominent figure, yeah. Obviously well respected at the time, but behind closed doors, he was doing some sketchy things. I guess the other thing to look out for is he was guaranteeing close to 20% returns annually. That's kind of a red flag right there. It's kind of questionable why other people weren't picking up on it at the time. Everybody else wasn't being able to guarantee. You can never guarantee anything, let alone 20% returns. So, that'd be a red flag to look out for.
Yeah, absolutely. Well, let's put an end to the old news and let's talk about the new news. Coinbase IPO last week. Pretty impressive open. I guess for those of you who don't know what Coinbase is, it's a trading platform for digital currency. And there's probably 50 plus currencies on there you can trade. Obviously, Bitcoin is more of a household name. I think Dogecoin is on there. Ripple is probably the future, wouldn't you say, Matthews?
Yeah, I mean, it's the biggest one. Like you mentioned, the different ones that it houses, but it actually holds more than 10% of Bitcoin. So they kind of were ahead of the game starting Coinbase. It was really one of the only players at the time when they came out of where you would be able to buy cryptocurrencies. They did a direct listing on the NASDAQ on April 14th. It was expected they might open at $250 for the price. It actually came out at $381. So that was valuing the company at the end of the day at $85 billion. So pretty significant valuation there for a company that's kind of starting out and kind of ahead of its game right now. As we mentioned, Bitcoin's a big thing right now with Tesla, as well as other companies like Square and big banks starting to back it. So this is kind of the beginning, you would think, of more companies to go public with cryptocurrency exchanges.
Yeah, what's interesting to me is how easy the platform makes it. They also make their money by charging a transaction fee. And we just kind of finished a cycle through the brokerage with stocks and, mostly just equities that are now trading for free. And there's a lot of other companies beside Coinbase out there you can purchase digital currency through. So as they IPO, as they gain market share, I just wonder if we're not going to see free transactions in the future, possibly. But even at the beginning of this cycle, the transactions really aren't that expensive. But anyway, it's going to be interesting to see Coinbase. It showed up in a few ETFs overnight. I think ARK was able to add that to their fund pretty quickly. And there's a couple other ETFs that also, ARK's not an ETF, ARK the actively managed fund, but the other ETFs, their passive nature allows them to purchase that. What am I trying to say? The index methodology allows them to grab the IPO right out of the gate. So I don't know. I mean, it could be like, once they're show full profitability and they've been around a while, this company could be on the S&P 500 in 2 or less years.
Yeah, it's surprising it's already a profitable company. So a lot's going to happen with other companies coming in the space, and as well as just the future of Bitcoin and cryptocurrency and how that evolves. Also how Coinbase evolves as a company. Like I said, they're currently making most of their money through transactions. If that's everybody's more transparent about that and there's fee compression like there's been on the retail side of the brokerage world, they might have to go out there and develop different products or different things that they're offering besides, just buying and selling the cryptos and making transactions fees on the front end and the back end.
Well, let's transition to something to just keep, these thinking about trading platforms. We look at Robinhood, SoFi, Upstart. These are all applications being used mostly by millennials right now for trading. And it's very interesting. I feel like that younger people are investing totally differently than maybe their parents would, focusing a lot of individual stocks, investing heavily in one particular stock or 3 or 4. But I feel like they're growing up. Sometimes I feel like I read the newspaper and I'm watching toddlers play. And you say, well, it's kind of silly what they're doing. GameStop being one example. But then, something else comes up. So now there's been a lot of money made in individual stocks. I think we over 150 plus stocks are now hitting their all-time high on the S&P 500. So we're kind of in a period where pick a stock and you probably have a 95% chance of making money in it, which is a little dangerous because it doesn't always work that way. But now we have a new problem, and that when these stocks get liquidated, the gains, you get capital gains. And so now these young investors are now realizing, oh my gosh, I have this tax bill. Why do I have this tax bill? And it's because they bought for $10 and sold it for $200, and now they have to pay a capital gains tax. Well, in big brokerage world, we're able to select certain tax lots that we can choose to minimize that tax. So maybe you bought a bunch of shares at the beginning and you added some shares at a higher price later, but you want to then, I don't know, let me try to make it a little more understandable. So $100, let's say I buy 100 shares at $100 each, and then later I bought 50 shares at $150 each, and now it's trading for $160. I could theoretically, in our platform, we could sell just those 50 shares with the lower cost basis, right? So the problem with these trading platforms is they've developed this maybe sophisticated, sleek look on the front end for trading, but they're not built. They haven't built in any tax efficiencies. So that's creating a problem for investors because they can't go in and choose their tax lots, and they understand this way after the fact.
Yeah, and you mentioned capital gains taxation, and a lot of these aren't even capital gains taxes. They've held it and they immediately sold it with a big gain inside a year. So it's actually ordinary income. So they're going to have huge tax bills that they weren't even aware of. A lot of investors probably didn't even know that. Not just specific lot identification in order to be more tax efficient with the way you sell it, but a lot of these platforms didn't allow or didn't have good accounting for wash sales. So some clients would buy and sell similar securities thinking they could do that, and there's actually going to be a wash sale, so they're going to lose the preferential treatment So there's a lot of issues with it. There's a lot of retail investors need to learn the intricacies of the ways you trade with the lot identification as well as wash sales. But a lot of these platforms have a ways to go on not just having gamification and the way that you can buy and sell things, but also educating the clients on what's happening when they are selling for these huge gains.
And to be fair to some of these platforms, you can make the trade and then you have 2 days to email them which lots you want to sell. In this day and age with technology, that shouldn't happen. When we make trades at TD Ameritrade or Schwab or Fidelity, we have a screen that pops up and we select which lots that we want to get rid of, or our software automatically selects it based on preset criteria, such as tax efficiency. So part of it too is the traders probably need some wisdom and to grow up, honestly. But so do the platforms. The platforms are built on the bare bones, and now when we get into more sophisticated tax strategies, they're unable to deliver that. So I don't know. GameStop, I think, put a black eye on Robinhood as far as liquidity. They didn't have enough liquidity to keep up with the trades just on that one stock. And then now we have the tax issue. To me, that's strike two. I don't know how much more they can take before they kind of become irrelevant, in my opinion.
Well, you mentioned 2 stock transactions. I mean, that's the thing. We're not trading all the time and don't advise it, but a lot of these people on these apps like Robinhood are trading thousands of times. So can you imagine having to keep up with the counting of 1,000 transactions, deciding manually which one was the best idea?
Yeah, absolutely.
It's a huge issue.
At GameStop, I think the average holding time is over 40 seconds, just over 40 seconds during the heat of the transaction. So, yeah, that would be a accounting nightmare. But again, if you build the software, it can do it. Everyone else is doing it. These legacy platforms can do it. I don't know why they didn't build that in. Let's shift a little bit to lumber prices. This is something we hear from clients quite a bit, clients that are building homes and then even clients that are trying to do some hefty remodeling. Man, the cost of lumber has gone through the roof. There's an article in the Wall Street Journal that I found very interesting, which was related to why is it that if you have a tree farm, you're not making any more money right now than compared to the people who have lumber mills, who have profits have gone through the roof, as well as Home Depot and Lowe's and the big DIY retailers. So I found this very interesting. I didn't realize that in the 80s that the U.S. government was paying, because most of the tree farms were here in the South, were paying farmers to plant trees over soybeans and corn, because I guess there was too much of that at that time. So right now, especially in the southern region, we have more trees than we need to produce the lumber demand. And so I think it was the prices that were 10, 15 years ago on the tree farm, they're still getting the exact same price, which is bad because if you don't, we have inflation, right? So those prices should be going up 2 to 3% per year. So that's not happening on that front. Well, then COVID comes along. COVID manages to cause the lumber houses to say, you know what, if we have this COVID, everything's going to stop. We're going to just liquidate this stuff. So they just liquidated their inventories to get it out the door. Same with maybe some of the retailers initially, only to find out they liquidated all their inventory at the beginning of a housing boom. And so I have this huge housing boom. We have restaurants that were having to build outdoor spaces, having to build even on indoor. You see a lot of plexiglass. What's that supported by? Typically a wood frame in a lot of cases. So we have this perfect storm in lumber right now that is causing things to be very, very expensive, with the person owning the tree farm not participating in it because there's too many trees. Basically, the lumber yards can name their price for trees right now.
Yeah, you mentioned the price that hasn't changed over the years. It's called the stump fee. So that's what the growers of the trees are paid from the lumber companies, and that hasn't really changed over the last few decades, which is unfortunate, especially considering right now that futures of lumber are up over 80% just this year alone, and your 2x4s and plywood have just skyrocketed. So it's unfortunate for the growers, but it's kind of a phenomenon that you're seeing right now. And a lot of analysts said that it'll take a while for the supply and demand to actually level out. Could be another 10 more years before this is really sorted out. So we'll have to see how that works.
Last topic. This one I don't understand. I mean, I do understand it, but I understand why we're allowing it to happen as a country. But we are in a position now where we're starting to have a labor shortage. People are returning to work. Restaurants are opening back up, and everywhere I look in my area, I see help wanted signs. I don't know about you, Matthews, but how you're closer to Atlanta than I am. Are you seeing the same thing down there?
Yeah, no, more towards the city. There's a lot more going on. There's always wanted signs. That's just people. There's a lot of jobs out there, but there's a lot of people that aren't returning to work, whether it be health concerns or just not wanting to return to work. So no, I think that's everywhere right now. Is this is happening?
What I find interesting, I have this data here that Brad sent over to me. So basically, unemployment is enabling unemployment. We have half of eligible unemployed received benefits that replaced at least 134% of their lost wages. So you had people who left the workplace who are getting paid 134% of their old salary not to go back to work. I would say that's probably not an incentive to go back to work. 2/3 received benefits higher than the lost earnings, and 20% were eligible for benefits that at least doubled their lost wages. So we're kind of entering this phase where the government is paying people to stay home, which I can't remember a time period that we would have experienced that here.
Yeah, I mean they're expecting 7.1 million jobs added this year, which is only leaves us slightly less than last year alone, 2019 alone. And job openings are exceeding pre-pandemic levels. Google data actually shows that the amount of people searching for work is decreasing, which is kind of unnerving. The fact that these jobs are available and less people are searching. So it could happen over the next few months as we see the reopening. You start to see the hairdressers and the restaurants and bars, the TSA at the airport, to kind of see how this all evens out, and if people will return to work because of safety reasons, or if just trying to hold off as long as they can.
And probably I would say in the higher paying jobs, people are going to be a little reluctant to hire until they see a full rebound happening in the economy. And there's no doubt the economic data is supporting a robust economy going forward. But sometimes I feel like in this cycle, they might hire later rather than trying to get ahead of it just because of the risk. I mean, we still have COVID cases increasing over in Europe. Although here at home, 50% of the people at least have the first COVID shot as of April the 18th. So there's some really positive things that are happening. I just don't understand. It's almost like we should be providing stimulus to people in certain industries. Certain industries were hit exceptionally hard, but getting paid to stay home, that's not American at all.
We'll see. A lot's going to come out, like you said, with the GDP numbers and the unemployment. So as things start to open up through this year and even the beginning of next year, we'll see if things return back to normal. But it'll probably still be the next 6 months or so before we're actually seeing these numbers that are a little more accurate.
All right, Matthews, enjoy the conversation. See you next time.
Enjoyed it. Thank you.